Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets.
New York sugar, ice raw New York sugar in New York. The main immediate pattern here since September 2024 had been, and still is I suppose after a fashion, the breached dark blue September to December 2024 bear channel, currently 1788 to 2074. This pattern achieved its primary downside target mid-January and its secondary hard to reach target about a week after the primary target. Interesting, the move down to the secondary target and back up again formed another new pattern, one which I'll discuss shortly. However, before that I'd like to highlight once again another larger long-term pattern, and that is the bright green breached November 23 to September 24 bearish Andrews pitchfork, highlighted in bright green as I say on my daily chart. This pattern, as I said, had been breached and is being breached again today as prices rise up through the upper time, currently at 1954. Now I'm considering finessing this into a shallower bearish shift pitchfork and maybe even retiring it completely. Probably do that next week if I'm going to do anything. We have two more patterns which I would like to discuss and maybe another to think about. The first is the mid-December 24 to mid-February 25 reverse head and shoulders pattern. This one had been a teasing pattern, initially looking like a reverse head and shoulders bottom, then like a reverse head and shoulders continuation pattern, and now like something else completely. I don't think I'll refer to this pattern after today, as I think it has spent all of its influence on the market. The second pattern is the bright pink late September 2024 to mid-January 2025 bearish Andrews pitchfork, which I drew 2 weeks ago to try and help make some sense of the recent moves. We are today in between the middle time below, currently at 1838, and the upper time above, currently at 2094. Elsewhere today, prices have just moved up over the green short medium moving average, currently at 1934, seemingly fairly easy, and we now have overhead the flatlining gold long moving average, not too far away actually, and that's currently at 2005, and a declining above that mauve medium moving average, currently 2023. On a cursory inspection, it seems that the mauve medium moving average is the better of these two as an overhead resistance at the moment. This leaves the possibility of looking at the mid-January to early March action as a possible bullish Andrews or bullish shift pitchfork. I haven't done much more than contemplate this as an idea right now, and it has all the issues of being part of a continuous daily chart as well. But it is now, how shall I put it, on my radar. To counter this, I will reprise part of my commentary from last week, and I quote, "So in an effort to get a handle on what further technicals were operating here, I went back to my annual commentary last week and looked at the monthly charts there, and I saw that the bright green Andrews pitchfork, despite the breach topside, is still the dominant pattern, along with the double top, an Adam and Eve type that had been constructed throughout 2023, which had already reached the primary target at 1880, leaving a still as yet unfulfilled, harder to reach secondary target down at 1630. This longer term pattern is the one I choose to watch, and I'll see how it develops," end of quote. These bearish ideas are becoming more and more eroded. Ice Europe, white sugar in London. There are now 3 features to bear in mind here on this daily chart. The first is the obvious purple late September to date descending expanding wedge pattern, currently 411.30 to 533.60. This pattern has more than the requisite 5 touches and was severely tested on the top side over late February, though into the start of March prices dipped back within the pattern. However, late last week the market pushed up over the purple upper trend line and has gapped even higher today, threatening the high made back in late February, just under the February 2017 high at 565 even. We're threatening that right now. The second is the January 24 to date downtrend, currently at 551.20, highlighted in bright red on my daily chart. It had effectively capped any rises since its start, most recently in late February, but is today being pierced, seemingly quite effectively. Watch this space. The third is the now flatlining gold long moving average, currently at 541.5. This had previously helped cap prices, but today the market has gapped up over it, and unless the market turns down and rapidly, which doesn't seem likely, then it will pare down its importance going forward. I'd now like to introduce some new features and a potential pattern. The first feature is to lay out some potentials for a move up and out of the purple descending wedge pattern. These may be a bit premature, but I'd rather lay these out now than later. Thus, the primary topside target X is in the 650.10 area, with a secondary, harder to reach target X1 up in the 673.80 area. Next is to view the whole late January to day action as a possible bullish halfway hesitation. If this becomes the case, and we'll have to see how prices perform over the February 2017 high, which we're just testing right now, then we can start viewing the primary target X2 up in the 605 even area. This is the closest of the topside potential targets and is worth considering. Finally, I have today drawn a bullish pattern. It is a bright green mid-January to early March bullish Andrews pitchfork. The market is right now heading up towards the middle time and is testing it at the moment. Overhead currently at 566.30. Just above, yes, you've guessed it, the seemingly key February 2017 high at 565 even. Now this is a nascent bullish pattern, and I'm quite prepared to finesse it into a shallower bullish shift pitchfork for the same move if needed. This is the first bullish pattern actually, apart from I suppose the reverse head and shoulders pattern I've drawn here for quite a while. I'm not sure of it, but with prices rallying and pushing up over some significant resistances, it's time I looked on the upside here. I suppose a lot now depends on what the market does, its actions, and also its reactions around that February 2017 high at 565 even. Sugar white premium spread. A holding pattern last week, but interestingly based on the support of the 1 year moving average, which is currently at 110, 111 even. So the market can still be seen as a continuation of the break up and out of what was originally a descending wedge pattern that developed into a big bear channel from April 24 to the end of January 25. 2 weeks ago we had the combination of another hanging man pattern, but also a bearish engulfing pattern and a weekly key reversal down. Now this tempered the recent rally and made the market look down from its heights, giving it a small sense of vertigo. Overhead we have the significant twin 50% Fibonacci lines of the July 2019 to September 22 move at 128.75 and the August 21 to September 22 move up at 131.25, plus the June 2020 high at 134.25. These together seem to, as I said previously, seem to have tempered the move higher and introduced some hesitation into this market. However, from the original large descending wedge pattern seen in 2024, we still have the topside targets with this break up and move higher, revealed 3 weeks ago, of a primary target X up at 137.5, which is above the immediate overhead resistances, and a secondary harder to reach target X1 up in the 154.5 area. So are these targets achievable? Well, yes, but there is a question mark hovering over all this, prompted by the combination of the previously mentioned 50% Fibonacci lines plus the June 2020 high and a congestion area we have overhead between 128.75 all the way up to 153 even, which will make target X perhaps hard and target X1 further up just that much more difficult. Today, once again, we're on the borders of entering this congestion area, but so far the market has not taken the bullish incentive by the horns. I'm sorry for mixing the metaphor there. We have not pushed just that far high enough yet. It was, as I said last week, and I quote, we even dropped down to the gold long moving average below, currently 110.75, let's say 111 even, to gain some support before finishing back up, but still below the previous 2 weeks closes. Apart from this gold long moving average, we really don't have that much below until we start approaching the 85 even zone. End of quote.
Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.